So we have an exam in a couple weeks. So we'll work some more of the problems as we get closer, so you can get a little more practice. The PML one should be a given, but some students lose points on what the company can do if the PML is too high. So just make sure you don't get too summarized there. But we probably need to practice the cat bonds a little bit more, because that is a little tougher exercise. But we were talking about cat bonds last time.
I'm sorry, and on the cat bonds, like the math and that, we have to every.
Yeah, I don't do any form issues.
Okay.
Yeah, that's actually, it sounds like real specific to cat bonds, but that actual math is used a lot in finance.
Yeah.
Those took my life insurance class, we did equity linked annuities. It's very, very similar type of process. So, all right. So just one last thing on cat bonds. Cat bonds, the industry loves them because it gives them more resources. There's more people funding their reinsurance, but they're more expensive than reinsurance. And that's because with reinsurance, if the reinsurer goes under, you're exposed to the reinsurer. With cat bonds, they can't go under because you got this trust with treasury bonds in it. So reinsurance is a little more risky. The wonderful thing about cat bonds is it does put a ceiling on what reinsurers can charge. They know they can't charge more than cat bonds. Otherwise, insurers would just buy everything as cat bonds. So they are more expensive, but they're lower risk. There's less chance that the reinsurer won't pay because it's a trust with treasuries. So even with the credit adjustment, my last analysis of this is that they're still paying somewhat of a premium for cat bonds, but the industry is still insisting on using them because they want that pipeline open. They're worried about Swiss Re and Gen Re and how concentrated they are. So, but let's talk about reinsurance. So we'll jump back up where have I come back here. So a reinsurance company is an insurance company that insures other insurance companies. Biggest players, Swiss Re, Gen Re, Munich Re, Employers Re. Employers Re used to be part of General Electric, and they sold it off. I think the last I heard, they're trying to sell it off. It's a very, very, very concentrated industry. It's like insurance with a massive, massive, massive deductible. We saw that when we were doing PML, where you saw the attachment point, 100 million, 500 million, a billion. Rate on line we talked about with auto insurance is really how people look at reinsurance. How much coverage do you get for the rate? So we talked about that earlier. So if you cover losses of over a billion up to 1.5 billion, your premium is 150, or I'm sorry, covers $1 billion in losses above 1.5 billion. Your coverage is $1 billion, and you're paying 150 million for it. Then your rate of line is 15%. You could do that with the cat bond examples and see how high that is. So here's where it gets a little tricky, because I've never built one of these, but I saw USA's, and USA's makes a lot of sense to me. The one I can find online or not, don't make as much sense to me. I can kind of see what they're doing, but you have these layers, and what the layers mean is from here to here, this is what covers it. From here to here, we cover this. From here to here, we cover part of it, they cover part of it. And you get your different boxes. It gets very, very, very complicated because it varies by state. So they might say, well, in California, we have reinsurance, but there's also the California Earthquake Fund. In Texas, we have reinsurance, but there's also the Texas Hurricane Fund. And so you don't know, you don't have a reinsurance program for the entire country. Like Hawaii has a special fund. So you have to, when you look at reinsurance, you have to ask which state are you in, which coverage do you have. So there's some that's overlapping, some that's not. So you have a schematic, and so I gave you a couple schematics. I just want you to kind of see what the one looks like. Again, I can't fully explain these. I don't have the insight, but just see these type of boxes. In the box, the coloring might be what they're, this is what we cover. One color might be reinsurance. One color might be co-insurance. One color might be cat bonds. Generally, they cover the small stuff, and as you go up, you get more coverage. And then at some point, they cover everything above that. So, at some point you run out of reinsurance and you're covering everything else. So I can't say what this is, but you just see the layering that goes on here. Sometimes like this with co-insurance, it covers this part and then the company covers this part or whatever, however they have it lined up here. I can't read those words. So in that case, some of it is covered, some of it's not. And then they have special layers where they have a special deal with a reinsurer just to cover that layer, really, really high deductible. Here's the Allstate one. So Allstate retention means what they're keeping. Again, I don't know why they have 3 columns. It might be different states or whatever. It's hard to read. I can't even see that. It looks like it's kind of muffed up. But as you go up, you have different coverages. One reinstatement, that just means what are they guaranteed that to have another year of business? It's kind of like, can they cancel us as soon as we have one accident, or can we reinstate? So you just see how it goes up with different levels, and at some point you're retaining everything over that last level, and you hope you have. How do they figure this out? Pretty complicated stuff. They take all those cat models, and essentially they're trying to figure out the best reinsurance program, and about the only way to do that is just run scenarios. What if you had this combination? How would it look? And you don't know the answer because it depends on which catastrophe you had. So what might be the optimal level here may not be optimal in this situation. So they got to run 1,000 scenarios and all the different combinations of reinsurance. Some win, some lose. They're trying to find the overwhelming strategy that works well. So again, the guy who did this at UTSA, maybe he's retired right now. If I can remember his name, I would try to contact him, but I can't remember his name. But the nice thing, it was a really weird name. So I probably could Google him and find him because I don't think anyone else has his name, but I just can't remember what his name is. I'll ask my friend at Victory Capital if he remembers him. But he would be an interesting class speaker because I'm sure he remembers all this stuff, and he could probably give some inside information because he's probably retired by now. Sound like a fun job, pretty intense job because it's really, really heavy at certain times of the year when you're reinstating certain reinsurance programs. So your goal is to manage the cost of the program to the impact on your PML. Your goal is to get that PML down to a certain level without spending too much for it.
Is that the one where you got to use a lot of computers?
No, that was a different model, but they were using the CAT models and just doing things in Excel. But we had actually talked about using that model for his reinsurance program. It would have taken too much to build it. It would have been pretty overwhelming, but he talked about it. He was very interested in doing that. He would have loved it on a million scenarios and then see which combination of reinsurance would have worked. Because it is very specific. You have a hurricane in Florida, that's a lot different than an earthquake in California. So you can't just assume we have a 1 in 500 year event. You have to say which state, what kind of event. It changes every single time. So it's a balance of expense of the program versus getting rid of PML. So reinsurance radically changes the order of the simulation. So what we did at USA, which I thought was a little overkill, but our CEO said, yeah, this is really overkill. He said, I want to survive us having a 1 in 500 event and the reinsurance pay us. And then we have a second 1 in 500 year event and all the reinsurers are bankrupt. That's what he wanted to survive. I was thinking, yeah, we'll be the only company still in existence. It's just, that's too conservative. Now, one of his exec council members said, that's a 1 in 500 times 500 event. But the actuaries pointed out that that's not the case because there's actually an event between 1 in 500 and 1 in 25,000 that's there, but it's a different scenario. So it's the probabilities of A and B or A given B and those kind of things, it gets really confusing. The math mistake that they made was exec council members were saying, well, if we had a 1 in 500 event, I could see us having another one. So that's A given B probabilities, right? That's a completely different probability. But again, we're talking about a 1 in 500 year event. It's never happened in this industry. They've never had a 1 in 500 event. So maybe 9/11 was, but I'm talking about homeowners here. So they're in their mind, they're probably thinking a 1 in 50-year event or something like that. We're talking, if it happens, you're going to be aware of it. It's going to be massive. The losses are going to be just massive, massive, massive. So kind of like the Tokyo earthquake, but hitting the entire United States kind of thing. And it's just something really, really, really massive. So they're thinking about something that's extremely rare being followed by something that's also extremely rare happening right after each other. That is an extremely rare event. That's what he wanted to survive. And his goal wasn't survival. His goal was we're still investment grade rated. So he didn't even want to be double B or single B. He still want to be triple B or higher. And we're like, that's crazy. And then we discovered that his compensation was based on that. So we could see why he was so conservative. But that's what he's looking at. So he actually was concerned about the reinsurers that, yeah, maybe they'll survive the first risk, the first event, but what about the second one? I can't explain maximal probable loss, but there is a difference between them. It does have to do with occurrences versus aggregate, 3 events versus 1 big event kind of thing. So it can be a little different. You actuaries can come back and explain it to me in a few years. All right. So that's homeowners. Let me show you what the state of Texas has on their website on homeowners. So if you go to their website, they have this for auto as well. I'm just letting you know it's out there. So homeowners covers dwelling, personal property, liability, medical payments, which is really, really small, and loss of use. So we talked about all 4 of those. On the liability side, we'll talk about umbrella coverage here. No, I think we already did, didn't we? Oh, I can't remember. But homeowners has limited. You can get up to $1 million. What most people do is they get like 300,000 of homeowners, and then they buy an umbrella policy for just liability. Liability is not a real big issue for homeowners like it is for auto. Types of policies, we talked about that, HOA, HOB, HOC. This means the policy language and coverages provided are the same regardless of the company writing the policies. So you're getting the same coverage. And we talked about this. Listed versus all risk type of coverage. So here's the things that are covered. Fire and lightning, smoke. Is it possible to have smoke without fire? It is possible if your neighbor is burning leaves. Even though you don't have a fire, you get the smoke. Explosion, theft, vandalism, riot, aircraft and vehicles. We're not just talking, so vehicles, we're not talking about your vehicle. We're not talking about your airplane, but an airplane flies into your building or drops a plane part or someone cars runs. And you might say, what's the chance a car runs into your house? But it does happen. In fact, there's a house outside of Austin on Pflugerville, to the word Pflugerville. It's on the corner. They had a car running through their house, I don't know, like once or twice a year. It was pretty crazy. They finally put a big, well, it was a sharp turn and there were some bars in that area. So they had some intoxicated drivers. So they finally put this massive stone wall in front of their house because they were so tired of getting their house crushed.
Did they get canceled by the insurance?
I don't know if their insurance company required them to build the wall or not. I should go look at that. That was when I was in high school. I was looking and see if they've solved that problem. Windstorm, obviously hurricane, but remember, storm surge is not covered. That's part of flood. Hail, sudden accidental water damage. Hurricane's not covered if you live on the coast because that's where you have to go to TWIA and buy your coverage from the state. Here's the mold issue we're talking about, sudden accidental water damage. And then what's not covered, flood, earthquake, termites, insect rights. You know, that's, have you ever, it's kind of grotesque. You'll see what's going on in New York City. Makes you not want to get in a hotel room there. Freezing pipes while your house is unoccupied, wind or hail damage to trees and shrubs. Trees and shrubs aren't covered. If your house is 60 days vacant, you got to do some special things, wear and tear, maintenance. That's where the insurance industry says, hey, that's where mold fits in. But the big debate was mold fits in there. Water damage resulting from continuous repeated seepage. So what's covered, what's not covered. If you live on the Gulf, you might have an endorsement that excludes coverage for wind. Most policies will not cover mold remediation beyond the amount necessary to repair or replace property damage caused by water loss, otherwise covered by the policy. Insurance companies are required to offer you mold remediation. This coverage will be offered in dollar percentages up to 100% of your policy's limit. So we talked about that with the limitations they put in. Texas law requires the insurance company to pay the full amount of the policy, even if this amount is more than replacement costs. Policy limits are maximum amounts your insurance company is obligated to pay after a coverage loss. There is an exception for fire destroys your house. In that case, Texas law requires. So I left out that. I should highlight this whole thing. Now I saw a video of this house that was burning down. So he called the fire department and said, "We're not coming," because he hadn't paid the $75 fire fee. So they said, "We're not coming." But then his house caught his neighbor's house on fire. And so then they had to come. That seems kind of bizarre to me, but you would think if your fire department has a fee, you would think it'd be required by law that you pay it. But if it's not, you would think your homeowner's insurance would require you to pay that fee. But that would be an interesting case to see who his homeowner insurance policy was with, and if they knew he had not paid that fee. We're not going to get too much in the replacement versus actual cash value. Cars, when you have auto accidents, that's actual cash value. House is replacement cost because you can't replace a 10-year-old house with a 10-year-old house. Replacement cost isn't market value, although there's definitely a close relationship between the two. So we're not going to get into this, but I have that in the notes. So you do have to have a certain amount of coverage to be able to get your, you have to make sure you have at least 80% coverage. HOB covers household content up to 40% of the dwelling, but that's going to be actual cash value, not replacement value. Companies generally want you to prove that you replace the item before they'll pay for it. Making an inventory. Yeah, so do an inventory. I don't know if we talked about this, but yeah, just get a video machine and just walk around your house and just film everything so you know exactly what you own. Your inventory should list each item. There's no way anybody can do this. Its purchase date, value, serial number, photograph or videotape each room. I agree with that, including closets, open drawers, storage buildings, garage. Keep the inventory and receipts for major items. Yeah, in another location. In fact, great use for Google Docs or Google Drive. Put it out there in the cloud so you have access to it. Texas ranks near the top of the nation in weather-related property damage, as we saw in the mold discussion. A large portion of this is flooding. Texas Windstorm Insurance, TWIA, is the state's insurer of last resort for 14 coastal counties and part of Harris and Galveston County. When a hurricane enters the Gulf, you can no longer change or purchase new windstorm coverage. That makes sense. Choose the highest deductible you can afford. That's that rate online. Make sure it makes sense. If you increase your deductible, but your premium doesn't come down much, it may not be worth it. That extra $5 or $10 might be worth it to get an extra $10,000, $5,000 in coverage. Texas requires rates for insurers offered in Texas to be, we talked about this earlier, reasonable. That means not too high. Adequate, that means not too low. Not excessive. I don't think there's a big difference between not excessive and reasonable. To the risk for which they apply, and not unfairly discriminatory. We're going to talk a lot about discriminatory rates when we talk about auto insurance.
What's the point of putting adequate? Why would they put it to? You mean like to get out market share? Like,
No, adequate means not too low.
yeah, but why would they?
Because they don't want insurance companies coming in and lowballing.
Yeah, just to get market share.
There's firms that do that in Florida. They go in and undercharge homeowners insurance. They know if they have a hurricane, they're going out of business.
Yeah.
But they're hoping there won't be a hurricane for 5 years. They pick up a lot of market share, and then they're.
Yeah, so wouldn't that be on them though? Like, wouldn't that be on like the company? Like, why would the government?
Well, original regulation of insurance companies was only focused on adequate. all they ask is, are they charging enough? Because their focus as a regulator was, we don't want this firm going insolvent. They're reasonable, not excessive. That was a more political thing that's happened in the last 50, 100 years. But yeah, when it first started out, the only thing they looked at was, you're not charging enough. You need to charge more. So yeah, the world's changed dramatically. Now it's almost that they don't care about this anymore, but they do. Like in states like Florida, they're worried about the fly-by-night firms that are intentionally undercharging, pick up market share. We're talking about events that don't happen every single year. You could undercharge and, hope for the best. And if it works out, you got some business there. Texas is a file and use. Unlike other states like Washington, California, you have to file, get approval before you use, which is really frustrating for actuaries because it takes them a long time. So the year might be over and you need to change rates and you still haven't gotten approved by the state. So it's really frustrating. So companies file their rates with the Department of Insurance. They don't need prior approval, but if the department determines that the rates are excessive, they can require refunds. Yeah, at Homeowners, we'll talk about this more when we talk about credit scores. What do they look at to charge you premiums? The age of your house, the condition of your house, obviously it's replacement costs. What construction materials are used, where you live can be important, obviously, especially for theft. How close is the fire department? Your claims history, they do look at that. Obviously, that's much more important on auto insurance than home, but they do look at it. And then we're going to get into this, your credit score. What kind of discounts can you get? Non-combustible roofs, burglar systems, fire alarm systems, sprinkler systems, fire extinguishers, home security devices. The Texas Department of Insurance actually does a lot of this going around the state and advertising how you can make your house safer, and they do some promotional videos and that kind of thing. Oh, there's more. Age of the house, premises in good condition. Make sure you're insured to the full replacement costs. Yeah, good claims experience. So they don't like you filing claims, but it's not as big of a deal on homeowner side. Marking personal property with identification numbers, other policies with same company group. There is like a multi-policy discount, and maybe senior citizens can get a discount. So we're going to talk about this more when we do auto insurance, but there is a plan in Texas to help people that can't afford the typical insurance. Surplus lines carriers, out-of-state companies not licensed in Texas, but legally eligible to sell insurance that licensed companies won't cover. You may hear of surplus lines carriers. Surplus lines carriers are not members of the Guarantee Association. That's like the FDIC for insurance. If an insurance company goes under. The difference between guarantee associations and the FDIC is the FDIC charges banks in advance, so they have a fund. Guarantee associations, they don't charge insurance companies until after a company goes insolvent. So they collect the money after the fact. So if you have like $100,000 claim from a company that went insolvent, the state will step in and they'll charge all the other insurance companies to pay your claim, but it could take a long time because they don't have the money yet. Yeah, non-renewal, if your company refuses to renew, remember that was going on during the mold crisis. Sorry. They might non-renew if you file 3 or more non-related claims in 3 years. If you move out of your house and it remains vacant for 60 days, the policy suspends. A company cannot unfairly discriminate against people in the same rate class with essentially the same risk. We're going to get into this a whole lot more, but this is key. Insurance companies have to prove every rate differential they have. It's not that they've discovered it internally and say, you know what, people with green hair drive a lot better than people with purple hair. They have to prove that to the state. They can't just start charging it, even if their actuaries have shown it and they can prove it. They have to. It has to be filed with the state and supported. We'll talk about that with credit scores. Yeah, I think that's it. So TDI has the same thing with auto insurance. I won't look at it for auto insurance, but they're trying to help you out, your taxpayers, tax dollars at work here. Okay. Yeah, ready to shift gears here. I don't know if you found your auto policy. You may not have it. They may not mail it to you anymore. It's probably online. But you may want to go see what coverage you have. We'll talk about this. This is the personal auto policy. There's also the business auto policy, which is very, very, very similar. So a covered auto, what can be covered by your policy? The vehicle that's described in the policy declarations, auto acquired by the insured during the policy period. So if you buy a new car, it's automatically covered, but you need to let the insurance company know. Now, I did that. I bought a car, drove home, called UTSA and said, hey, I just bought a new car. And they said, yeah, you bought this model this year. They already knew somehow. I don't know how they knew. I didn't tell them. So some big brother going on there. But yeah, they already had it in their system. But I don't know what the auto dealer must have done something. I don't know what. But you are covered. So if you buy a new car and you forget to call your company, you're covered for 30 days. But you need to let them know because they're charging you a premium based on the replacement cost. And the replacement cost for your old car might be $10,000, but for this new car might be $15,000. You know, you may not have the coverage you want if it's a more expensive car. If it's acquired in addition to declared auto receives broadest cover applied to declared vehicles, but you must notify them in 30 days. So if you have a second car, auto used by the insured on a temporary basis. So we'll talk about rental cars here some.
Is there a law saying that it has to be insured, even if it's not on the policy within 30 days, or does it vary by company?
It has to be I'm sorry.
Is there a law saying that it has to be insured within the 30 days, or does it just vary by company?
Well, that's 30 days is probably most state laws. Remember, this is somewhat generic, so it probably varies by state. There probably is a law that requires them to have that window for a certain number of days. It's not the insurance company's charge. This is the standardized policies, so that if they're saying must be, that means it's required by the insurance company. It's not their option. In any trailer owned by the insured. So we're going to talk about rental. One thing I would absolutely tell you, don't assume things about rental cars. If you go to another state, especially if you go to another country, don't assume you just show up for rental cars. And like in the States, I never bought a rental car insurance because your auto policy, I think, covers you adequately. But like in Costa Rica, you don't have a choice. You have to buy the Costa Rican auto insurance. The last time I went to Costa Rica, the car rental was like $300 and the insurance was like $500. The insurance was more than the rental car. If you're not aware of that, now we went to Europe and we didn't check in advance, so we didn't know. So if you're going to travel to another country, I would call your insurer immediately and ask, do I need to buy the insurance? What do I buy? Do I need the liability in the property? A lot of times, your insurer will cover you, but you may be out the cash. You may have to give that rental company, $10,000, and then your company will reimburse you. So, there may be those issues. But in some countries, you have to buy the insurance from that country. You can't bring your U.S. insurance into the country. And in Costa Rica, it's horrendously expensive. So anytime you're going to go and rent, I would check into it, be real clear. If you're not sure, call your insurance company and just ask them, hey, I'm going to Vegas or renting a car. I've never rented a car like this before. Some people rely on their credit card. Read it very carefully. What does your credit card cover? Does it cover the liability? Your liability should be covered very adequately by your insurance. That shouldn't be an issue, but just be real clear what it covers. Is there deductible? But yeah, be careful on that. But the best thing is to call. The mistake we made in Greece is we just didn't know. And so we're all debating. I'm like, I don't think we should pay it. I think we're covered. And they're like, no, we don't. And it was really expensive in Europe. So you don't want those debates while you're on the trip. All right, the policy itself is real similar to homeowners, except for the liability and the property are switched because the liability is the most important. So it's part A, and then the property is part D. And you see there's a lot of stuff in between A and D. So part D is the coverage or the physical part of your car. The liability resulting from ownership, maintenance, operation of an auto. So you don't necessarily have to be driving the car to have liability exposure. Most states or all states have some type of a liability coverage requirement. It depends on the state. In Texas, it's required by law, and you've got to prove proof of insurance when the police stop you, and probably on some of the bases still, you have to prove it when you go on base. There are state limits. The state limits are usually very, very, very low. You probably need a lot more than that. It has to do with per accident, for one person, for multiple people, and then your property coverage. So 10,000 if one person's damaged, hurt. 20,000 for more than one. 5,000 for the property damage. That's just not nearly enough. Now these rules may have changed. I'm using the original, so who knows? And each state can be different, and each state is different. So now you don't have to worry if you go to another state to say, wow, the rules are different here. So Texas has, or states have this thing, if the minimum in your state's 50,000, another state's 70,000, and you only have the 50, you're automatically covered for 70 when you go to the next state. So you pick up free insurance when you do that, unless you move there permanently. I'm not going to get into these different types. I don't really care. They're not that important. It kind of depends on when do you have to prove that you have it. So in Texas, you have to have liability insurance at all times. Some of them say when you have your accident, you have to prove at that point that you can pay for the accident. Texas, you have to have the insurance in advance. There are some people that are wealthy enough, they can take the exception. I don't know if that's true in Texas, but there are some people that say, hey, I'm Bill Gates. I'm not going to buy auto insurance. I mean, the state minimum is 50,000. Obviously, I've got enough to pay it. But for most of us, we're going to buy the insurance. It's pretty cheap insurance. If you look at your liability part of your policy, we're not talking the biggest part of your coverage. I don't know if y'all looked at your policy. So don't just look at your policy and figure out how much you're paying for A, B, C, and D. Look at each part and see how much that liability is. I bought a lot of liability because it was so cheap, and I'm worried about it because I'm retired, I'm living off my portfolio. So to me, and the most dangerous thing I do is, at least, to other people, the most dangerous thing I do is ride a bike, but the most dangerous thing I do to other people is drive a car. And so I want that coverage. So I'll let y'all read those. Each state is a little different. Do they work? Compulsory laws. The evidence is really mixed. In fact, there's more uninsured motorists in states with compulsory laws than there are in states without them. Does that mean they don't work, or does that mean the states with them have a bigger uninsured motorist problem, and that's the reason they have the compulsory laws? We don't really know. It's hard to say. Supposedly there are states where the police can tell if you have insurance just by getting your license plate. I don't know how that works in Texas. Now you don't necessarily have to have your card to prove it, as long as you can get on the, now you just go on your phone, you can show them as long as they know you have the insurance. So yeah, well, y'all wouldn't know. I don't know what the penalty in Texas is for driving without insurance. Maybe we should look that up. I would assume it was a steep penalty. Did he tell us? Fines ranging from $175 to $1,000, depending on number of offenses you have on record, and the annual surcharge of $250 for 3 years after the conviction. What does that mean? Surcharge by whom? Vehicle impounded for 180 days until you prove. Wow, that's pretty serious. Oh, Texas minimum car insurance requirements. That would be interesting to see. 30, 60, 25 in Texas. 30 is what? You injure one person. 60. And then 25 is the property coverage. So that's way too inadequate, right? You need to buy insurance, not based on what you can afford, but based on your responsibility as a member of society. You know, what is 30,000 cover? I guess you could, a broken leg, you could cover that. If you kill the person, 30 doesn't sound like much. Now, can they sue you if you don't have enough in your auto? So yeah, they can sue you. Well, we're not going to talk about no fault insurance, but it's possible. So I'm assuming this page is accurate, but I don't know. All right, Part A, the insured is the name insured, his or her spouse, or any family member who owns, maintains, or uses the auto. For friends, you must be using a covered auto for them to have that liability coverage. Any person using a covered auto, any person, organization, legal responsible for the person using the covered auto. Employer can receive coverage under PAP policy. Any person or organization legal responsible for actions of the name insured. Driving another's car for another organization causes loss, or organization gets coverage. So it's pretty broad coverage. The coverages you get, obviously, your legal costs, your bail bonds, interest, the expenses could be lost earnings, and then obviously the claims. What are the exclusions? Intentional things are generally excluded from insurance. If it's intentional because you loaned the car to somebody else, you'd be covered yourself, unless you knew that person was a problem. Damage to owned or transported property, you can't be liable to yourself. You can't use Part A to cover your own property. That's what Part D covers. Injury to an employee in course of employment, that's what workers' comp is covered, unless there is no workers' comp. If you're doing things that are essentially a business, you're running a business, that's not going to be covered. If you're in the auto business, like parking, repairing, selling, servicing. So none of y'all watch Seinfeld, so you won't know this one, but George Costanza was parking people's cars and he caused a major disaster because of a Woody Allen movie. So, you know, it's a strange TV show. But
So good.
every time I watch that, I'm thinking auto insurance. Is he covered? Is that covering? That's a business. He's doing it for a fee. You know, he might be in trouble. Did he know to call his insurer and check on that in advance? Who knows? Someone using your car without permission. So if someone steals your car and causes all kind of damages. Unusual vehicles, fewer than four wheels. Now, motorcycles are covered, but that's not your auto policy. This is a separate policy. Dune buggies, things that are not meant for the normal roads. An auto by insured, regularly used but not insured. That's not going to be covered. Racing and speeding contests are not covered. So out-of-state coverage, already talked about that. You're automatically complying with state laws anytime you go to another state, as long as you have your states. If you have dual insurance, boy, this gets so tricky on medical, but on this, like if you do put your car on your credit card and there is some liability, a lot of times if you rent something with a credit card, the credit card is going to cover first and then your insurance comes in second. But there could be pro rata. It depends, you know, the credit card will tell you what the coverage is.
Didn't you, on the first one, get insurance in a state that requires lower premiums than the one, like,
Well, no, if you regularly live in that state, you're going to have to tell them you live in Texas.
yeah, so it's more just like insurance fraud.
Well, I don't know if you fraud because you just say you forgot. I mean, people move to another state and probably forget to tell their insurance company. Now, if you move and you change your homeowners, they'll probably transfer you to the auto side and say you need to move your car as well. But yeah, you're probably not saving much. We're talking about Part A here. You know, you maybe saving $10 or something. You know, this is really, really cheap insurance. The rate online on this is really low because, I mean, it's a higher liability in homeowners, but it's still not as a huge expense. All right, let's talk about the insurance I hate. Part B and C. I do not buy it. My guess is everyone in this room has it. So why do you have it? See if you can convince me to change my mind.
We're writing a paper on this, right?
On this one? No,
We're writing an argument for why we shouldn't do Part B and C.
no. Y'all want an article? It's not even an exam question, no. But still listen, it's important stuff, but no. Part B is strange. We'll jump to C first because that's the one people say, how can you not have Part C? So Part C is uninsured motorist coverage. That's coverage if someone hits you who doesn't have insurance or hit and run, you don't know who hit you. You gotta say, how in the world do you not have that coverage? Well, you still have Part D and Part D still covers you. So it's not like if an uninsured motorist hits your car and destroys it, that you don't have any coverage. Your Part D still covers you. Now you have to pay the deductible, so you're out the deductible, but you still have coverage for your car. So what does Part C cover you? So Part C, we're going to talk, here's where I talk about uninsured motorists. It covers bodily injury, medical costs, lost wages, bodily injury. What kind of insurance does that sound like?
No.
Health insurance. If you have health insurance, what happens? The first question they ask you, were you in an auto accident? Why do they ask you that? Because your health insurance company doesn't want to pay the bills. If you say yes, what do they say? Well, call your auto insurance company. What if you say no?
They have to.
You're covered. All right. So if you buy Part C and you have health insurance, you have two health insurance policies and they both cover you. It's just that if you have the auto one, it covers you instead of your health insurance. If you don't have the auto, your health insurance covers you. Jay?
So if they figure out that you're lying, like, that you actually did get in the car crash, would they say that's?
Well, I wouldn't lie to an insurance company. That gets really dangerous. So, and you don't really have an incentive to because it covers you either way. All right. What about this next?
So if you do have health insurance and they tell you to contact your auto insurance and you don't have Part C, then they still have to cover you.
Yeah, your health insurance covers you. Yeah.
Right.
What does medical costs sound like? Health insurance. What about lost wages? What is that? That's disability insurance. At USAA, we had disability insurance. If I miss work because I got injured, USA pays my salary. I don't have that now, but I don't care because I've got my portfolio, so I'm kind of taking care of it. But yeah, lost wages. If you work for a major corporation, you have disability insurance already. It covers this. So those are already covered. It covers for compensatory. So this is the one to remember. This is one we're going to debate. I always lose this debate with students. So property damage is covered by endorsement, but you don't really need it because it's covered by Part D. So that's really not, there's some minor things like towing labor, and there's some things that you get a little more coverage here, but we're talking small dollars. We're not talking massive dollars. So I'm going to argue that the main thing this covers is duplicate insurance. You already have health insurance and disability insurance. Now, bodily injury could be your death, so that's life insurance. But so I've had people say, this is the only health insurance people have, so you shouldn't cancel this. But my question is, why does someone's only health insurance require them to be hit by uninsured motorists for them to get it? That sounds like a really horrible health insurance policy. Or that's what you talk about, insurance fraud. Hey, I broke my leg. Can you put me in a car and just hit and run and I won't tell anybody? And then, that would be a really wild thing to do. But that's kind of the argument they're making.
I just want to make sure I heard you properly with the lost wages, major corporations. So it's like you work for UTSA. So if something were to happen.
UTSA doesn't provide me disability, but USAA did.
Oh, just placed on. Okay.
Yeah.
But-
I might. I just have never looked into it.
So when you were working at USA, had you been like you ride your bike all the time, if you wouldn't have auto insurance.
Oh, anything would have been covered. Yeah, if I miss work, they have paid time off, and then they have, which is kind of short-term disability, and then I have long-term. Yeah, they cover all of that. Yeah, it's covered. Now, will they call and say, "Hey, did you get hit in a car accident?" You've got this Part C to cover you. So the one thing you may not have insurance for is that. So what is compensatory damages? Anybody know what that is? There's another word for it. I'll give you the letters. Did you guess? Pain and suffering. So if an uninsured motorist hits you and you break a leg and you're in horrible pain, or maybe you're permanently disabled, your disability insurance covers you, but you're in terrible pain, this coverage will give you pain and suffering. My answer to that is, I don't care. I've had students say they care a lot. If I'm in horrible pain for the next 10 years of my life, giving me $100,000 does nothing for me. I don't care. It doesn't help. It doesn't make me happier. I just do not care.
How do they measure that?
Well, I don't know. Juries somehow figure that out, but yeah, you can probably have to go to court to figure that out. I remember asking one class and I said, $1 million, would you be willing to take horrible pain the rest of your life to get $1 million? And I'm thinking everybody's going to say no. And one student said, yeah, I would. It's just crazy. I can't imagine. That would be a horrible life. So money doesn't make me feel better if I'm in pain. I just hate pain. So maybe I'm a wimp, but I don't like it. I don't like pain. Pay me money. Now, I'm independently wealthy. I live on, so, $100,000 is like nothing. Maybe a poor college student, maybe that would make a difference. But is that important to you? If that's important to you, that's to me the one thing Part C is covering that you don't have. You can't buy pain and suffering insurance. Your health insurance is not going to say, you're in a lot of pain, we'll give you an extra $10,000 a month to cover that. They're not. They're going to cover your medical bills. Hopefully your medical bills include pain pills. That would be covered, but that's not covered. So I don't care about that. I don't need that, but that is a big part of it. So I got into this huge Facebook debate with a personal injury lawyer that I knew from high school. This is what he insures. So this is what the cases he covers. What I reacted to is he said, you'd be a fool not to buy this insurance. So he's calling me a fool. So I respond to him. So I would never buy this. I think it's ridiculously overpriced insurance. You're paying way too much for it because you have all that duplicate coverage. And so I don't think it makes any sense. His arguments, I thought, didn't make sense, but I kind of got it. Facebook is not the best place for that kind of debate. And then all his lawyer friends jumped in. And this was the thing they said is, no, this is important. You need compensatory damages. It's like, I just don't care. So maybe I'm the unusual one that's not important to me. But let's look at this debate. Now, what is B? So what B is, I think even worse, is medical payments. It's medical payments if you're driving a car and you get in an accident, it covers your medical costs from that accident. What does that sound like kind of insurance? That sounds like health insurance again, right? So Part B is just more health insurance, all right? Really complicated health insurance. A friend of mine, she was in a horrible accident where they had to actually skylift her out. And she could not get her medical bills paid because her health insurance company and the guy's auto insurance company kept debating with each other who was going to pay for it. She's like, I need my bills paid. And they were like in this big battle between the two of them. So it actually creates a mess. She would have been better off. No, her auto insurance company. She would have been better off if she didn't have Part B because then her health insurance company would have just covered it. But these are arguments I found online. I was tempted to have my lawyer friend come and debate me on Zoom or something, but he's a lot smarter than I am, so I didn't want to risk that. But he obviously has a huge incentive to do this. So your financial losses would include any medical expenses, so that's health insurance, any loss of income, that's disability, and your diminution to your ability to earn money in the future, again, that's disability insurance, and household-related help assistance. So that's another one. If you're unable to, maybe you need daycare, or you need, maybe the person that injured was taking care of the kids or was doing household activities, you could hire that. That's not something I'm all that worried about. So you have to ask. But then pain and suffering. That's, to me, the biggest one. So on this one, I just self-insure. But pain and suffering, that's not covered. That's the one thing you get when you buy this policy.
That's also B.
I'm sorry?
That's also insurance B.
Well, if you buy Part C, you're going to get some pain and suffering. Up to your limits, depends on what your limit is, but you get some coverage.
So when we were speaking, going back to what this was uninsured motorists. So if you hit me, but you are insured,
Well, if I'm at fault, Part A covers. or if I hit an uninsured motorist and I'm at fault, my Part A covers me and them.
Right,
If they're at fault and they're uninsured, my Part D covers my car. My health insurance covers my health care, my disability covers. But if I had Part C would cover my health, my disability instead of my health insurance.
okay,
So no, if I'm at fault, none of this matters because then it becomes Part A.
okay,
Now, if I'm at fault and the person I hit leaves, now if they don't have insurance, they're still covered. They may be in trouble for not having insurance when the police show up. But if they leave, a hit and run where I'm at fault would be kind of crazy, right? But for some reason that happens, I don't know what happens in that case. I mean, if they come back and sue me, then my party would cover me. If I'm like, hey, I hit this guy, it was all my fault. I tried to stop him, but he fled the scene. I guess I wouldn't have to worry about it. That would, not much I could do. But my policy is not going to cover my pain and suffering. That's going to be there. But Part C, if they're at fault and causes me pain and suffering, then that's going to be covered by Part C.
so, just a quick second, because I was in a hit and run, I was hit and the person left. So who covered my medical? Because they never found the man who hit me.
If you had Part C would cover it.
So everything was covered, I didn't have to pay out of pocket, so that meant.
Well, the question if your auto covered it or your health insurance covered it.
It wasn't health insurance, it was,
Yeah, Part C would have covered it. You would cover it.
so because that person left,
Yeah, that's the same thing as uninsured. Hit and run is a special case of uninsured because you don't know who actually hit you. There's a lady at my church. I don't know if she's still living. I've helped her. I helped her with a big battle with her life insurance company, but the sweetest little lady, but she was involved in hit and run. She had Part C, which for her kind of worked out. But she was hit by hit and run. Her car was disabled. She couldn't drive it. So she called the police. It took them like an hour to get there. This poor 80-year-old woman's out in the middle of nowhere.
that was me.
That was just horrible. I couldn't believe they didn't hear her voice on the phone and send someone out there with the sirens going. But she wasn't at risk, so they just let her sit out there. But she had Part C, so she fortunately didn't have any medical issues, but it did cover the towing and a rental car and those kind of things. So this is a discussion. If you talk to your insurance company, they're going to say you're an idiot not to buy this, but then they're selling it to you, so they have a conflict of interest. But what I would do is go through the scenarios. I have health insurance. What does this cover that doesn't cover? I have disability. What does this cover? Go through the extremes to see what you're giving up by not buying this.
I was just gonna ask if in this scenario where there's a run, then who has more of a liability if there's not a date that the health insurance is gonna cover or the auto insurance? Then who has more of a liability to cover?
Well, if you're hit and the other person's uninsured and you have Part C just takes over. Your health insurance company will ask you, were you in a car when this happened? They're asking you questions because they want to shift it over to your auto insurance company. Now, in the case of the lady that I was talking about, while the two of them were debating, I don't know what the issue was there.
So who ended up covering?
I didn't hear her last story. She was just frustrated. She had to have screws drilled into her hip to hold her body together. She's a piano player, so it's kind of really, really good piano player. So her legs were injured. So it was, from her standpoint, a pretty serious thing. But she kept telling me, no one will pay my bills. I keep calling and they're pushing it off to the other side. That to me is almost an argument not to buy Part C's, because then you eliminate that debate altogether, because then your health insurance just picks it up because, hey, all I've got is health insurance. So, so what's the incentive for getting this? It's not the health insurance, but it does cover it. To me, it's these other things that you have.
So if I am at fault and I hit someone, then if they're injured, then my Part A is gonna cover.
Part A, yeah. Part C wouldn't have anything to do with that. Part C, if you're at fault, Part C is completely doesn't matter. Now, Part B can matter. That's medical costs. But again, if you have health insurance, why do you care? You don't care. That's kind of my view of medical. Is I don't want 3 different medical policies. One that covers me when I do this. I just want to be covered for my health care. Don't tell me, hey, were you swinging on a swing set? That's covered by this. Your homeowners policy. I don't want that kind. I'll just give me a health insurance policy that covers all health care. Don't have any health insurance in my auto policy at all. That's what I prefer. Because I'm paying twice for the same thing. You know, so I don't like that. But you know, life insurance, you've left dependents, that's what life insurance is for. Life insurance is a lot cheaper than this insurance anyway. So if you don't buy B and C, where else could you spend that money? That was my question to the lawyer. This is really expensive insurance for the coverage you're getting. You can get a lot more coverage. So my argument with him is, all right, so it's $200 a year for this family that has no health insurance. And the only health insurance they have is Part C. So the only time their family is covered for medical is if they're fortunate enough to get hit by an uninsured motorist. Otherwise, they have not. I would think they'd be better off buying a really cheap, bad health insurance policy for $200, at least having coverage for other things like cancer or whatever else, and not just for this one thing. But that was my debate: is could they buy this coverage elsewhere for a lot better? Now you might say, "Wow, this sounds really serious." So what if instead of buying Part C, they bought life insurance, which they could buy a whole lot of? So I don't know how good this, and you probably don't want to think about this, but how good the sample size is. How many people do you know that are seriously injured today because they were hit by uninsured motorists? And how many times can you think of someone who's died prematurely with dependents? Which of those is more common? I think I can make an argument they could better spend that money on life insurance than they would on Part C. They should have health insurance, period. But if you're going to have health insurance plus this, I think they may be better off buying life insurance. I don't know anyone who's been seriously injured by an uninsured motorist, but I'm sure they're out there. Now, the lady I was talking about, she wasn't injured physically, but her car was, but her Part D would have covered that if she didn't have C. I'm not trying to get you not to buy it. I just want you to hear the debate. Second example, this one's proving that it's good to buy uninsured coverage because he had a claim. All right. So that's like someone telling you, you should be putting hundreds of dollars in the lottery tickets because I won the lottery last year. Does that sound like a good argument? You should be going to Vegas with all your money because, man, I won in Vegas last year. That's not proof. That's a sample size of one, but that's his argument that he's making. So we're talking about very low frequency events. We're not talking about auto accidents. We're talking auto accidents involving uninsured motorists where there's a major medical issue going on. That's a pretty rare event. I mean, think about the opposite of, have y'all seen the insurance fraud where the person pulls in front of a person and slams on the brake, hoping they get hit to get the coverage? You're at fault if they get that claim, not them. And so that's a little bit different thing. But yeah, we're talking about someone hits you, doesn't have insurance, you're physically seriously injured. The claim triggered my collision deductible, so he had to pay the deductible. Might raise his rates. I actually question that. So I don't know how he knows it's going to raise his rates. If you're not at fault, they shouldn't raise your rates because it's not you. So if they're raising your rates, they think you did something that makes you a more dangerous driver. Actuaries don't just raise rates because you had a claim. So hit and run, my uninsured motorist coverage was triggered rather than my, your Part D, other than collision. So yeah, he's not making a convincing argument to that. First, my deductible was reduced, so it saved him $250 right off the top. Did it really save him that? He paid for that insurance. So the question is, how much did he pay for the insurance that saved the $250? My damage wasn't my fault. It didn't count against me. It still wouldn't have been your fault if he had the Part D anyway, because they're gonna ask whose fault was it. It covered my rental car. I mean, you're gonna get covered that as well. I mean, all comes down to deductible. The prime example here with all insurance, I don't know if you agree with this. I don't. With all insurance, it's a good idea to buy as much coverage as possible. What did I say about insurance? It's always 100% of the time a losing proposition. Why? Because if you pay $100 on average, 70 of that comes back to you, 30 of it stays with the insurance company, unless it's title insurance, and then 5 of it comes back to you and $95 stays with the insurance company. insurance is always a losing proposition. Maybe you win some, it's just like Vegas. Really, if you go to Vegas, you might win every once in a while, but on average, the house is going to win. With auto insurance, on average, you're going to get back less than you pay in. So you shouldn't buy as much as you can possibly buy. You should buy the best coverage for the most coverage that makes sense for what you're paying. With that uninsured motorist, I've been hooked for more than twice. We're talking about a few $100s here, which he's probably paid over a few $100s for this coverage over his life anyway. So he's still come out behind. But I do know people that are like that. They'd rather pay $500 in insurance than occasionally have a $200 bill they have to pay. I don't know why that is. I guess they really love insurance companies. So remember this, sometime your idiot professor tells you uninsured motorist is unnecessary if you have Part D. You never know when you will come out of the grocery store and find a door slammed and no one left you a note, right? You don't know when that's going to happen, but you're already covered with Part D. So you're going to pay an extra $200 in premiums, or every once in a while you have to pay a little bit more out of pocket for the claim. That's what you're asking. Here's a third example is pedestrian. You're hit as pedestrian. You covered as coverage. You get hit by a car while you're trying to cross the street. You're covered by this policy. Medical expenses, lost wages. Again, we're talking about medical insurance. It could be covered, important because even if you have medical payments coverage, those still won't cover lost wages. But if you have disability insurance, so again, y'all see my argument. If you need health care coverage, you should buy health insurance. Don't buy a policy only covers you for automobile accidents. If you need disability insurance, buy disability insurance. Don't buy a policy that only covers you when an uninsured motorist hits you. Many people have their employer, but it would not cover your passengers or family members. I think that's great. I get away with that at my church. They say, hey, Ron, can you drive 6 teenagers to this thing? I don't have Part B. Sorry. If they get injured, their medical's not covered. If they don't have health insurance, it gets you out of driving teenagers around. How many of y'all want to drive teenagers around? Nobody. So, right, it gets you out of that. So I actually use that as my excuse. I've been tempted to put a sign in my car. I have no Part B. If you don't have health insurance and I wreck the car, now, does that mean they're not covered? If I'm at fault, what does that mean? My Part A covers it. The other driver's at fault. They can sue that other driver. They can't sue me. But what should be the answer? They should have had health insurance. You know, that's what they need. It's like, I don't have health insurance, but hey, as long as I'm only injured and riding in someone else's car, I'm in good shape. That doesn't make sense. But that is true. If you have people in your car that don't have health insurance, Part B would cover them. So just tell people, you know, just letting you know. I don't know how people would react. I'm just letting you know I don't have Part B auto insurance. Just letting you know. They're probably going, what's Part B auto insurance, right? So I'm just letting you know if I wreck this car, or if this car gets wrecked and I'm not at fault, then you know, there's no health insurance coverage for you. Unless the other drivers are at fault, and then you can sue them, but they may be unsure. You know, you got to go. It's too long of a discussion. So just don't drive people around.
So, but if it's your fault, your Part A covers, right?
Yeah.
Okay.
Yeah. So Alec, did you have health insurance? I shouldn't ask. I gave him a lift the other day, but yeah, I should have warned you, right? So it could have been dangerous. They say you probably can't afford to drive without it. I think you can, but that's just my example. I love this one. All of the other benefits you get for uninsured: pain, suffering, disability, scarring, disfigurement. Is there a difference between scarring and disfigurement? Mental anguish, that's pain and suffering. Loss of the enjoyment of life, what is that? That's pain and suffering. Lost earnings, that's disability. And earnings capacity, that's disability, as well as unpaid medical expenses. So he had a good list. He just kind of kept using the same term and just changing, you know, he's got the same thing in there 3 times and just uses different terms for it. So yeah, it makes it sound like it covers a lot of stuff, but it's essentially pain and suffering, medical, and disability. It's essentially what you're getting covered, with a little bit of deductible and a few other things that are pretty small. Beyond having their medical expenses paid, someone carrying no coverage would stuck by uninsured would receive no compensation for all of these things. No one ever believes they were involved in a serious motor accident, but every day throughout the state, hundreds of people are seriously injured. Who will compensate them for substantial losses? Well, their health insurance, their disability insurance, their life insurance. So how important is pain? I think it comes down to how important is pain and suffering for you to be covered. So there is something else to consider. If there is any liability coverage available to provide compensation for one's injuries, even though it may be woefully inadequate, Medicare and virtually all health insurance policies have reimbursement rights. So yeah, that's true. If you have this coverage, essentially what they're saying, you can't double dip. You can't like do the auto Part B and get your health insurance. But that's fine with me. I didn't buy health insurance as a lottery ticket. Say, hey man, if I break my leg, my motor's going to pay me $3,000 to fix it, and then my health care recovery $3,000. I'll make I'm not buying health insurance to have some big windfall at the end. I don't mind. I just want them to pay my bills. So now the Walmart case, I wish I'm going to try to find it again. This reimbursement can be a serious issue. I really blame her lawyer on this. So this is a lady who's driving her car. How are we doing with that? Okay, this will be the last thing. Driving a car. She was hit by this professional big truck, this truck driver. She was very seriously injured. She worked for Walmart. So the guy that hit her, his liability covered her. Unfortunately, it didn't cover all of her expenses. But what happened, and Walmart really messed this up, is Walmart's health insurance covered her, but once she got her settlement from the court case, Walmart says, hey, you got $150,000 for healthcare. We're covering your healthcare. We get that $150,000 from your settlement. Now, it hit the news, and it was just a horrible headline for Walmart. Walmart's argument is they didn't have any choice. Their contract required them to do that. They had to go and get that. What I think, I wish I could show you the case, because what I think was horrible about this case is her lawyer got over half of the settlement, and it wasn't enough money to cover her. So I blame her lawyer. Everybody's talking about how evil Walmart is. It's like, why didn't her lawyer sue for more if she had all these health issues? Walmart's argument was, we can't just let this go because our premiums are based on this reimbursement. And if we don't reimburse, we're going to have to charge all our other employees more. I can kind of see their argument. If I were Walmart, I would have just covered it, behind the scenes and say, we'll just cover those, because it was a horrible headline. But it just shows you how much personal injury lawyers make on this. So yeah, I agree. There is reimbursement, and it looks really horrible and on the surface. So the only way someone can protect themselves is carrying the maximum amount they can afford. I don't agree with that. You should never buy the most insurance you can afford. You should always buy the most insurance you need based on the premium. Here's another example. Provide greater flexibility in care. Yeah, there's some other things that you can do. Maybe it's a little bit better, but I don't buy it. I'm not saying you can go buy it. We'll talk about the price this next class. I did look at my policy. How do you figure out how much this costs you? Just go online and go to your insurance for an auto policy and just cancel. Don't cancel it, but price it without B and C, and just see how your premium changes and see how much you're paying. If it's $40, yeah, probably keep it. If it's $250, I think you got a decision you need to make about whether it's worth it or not. All right, we'll stop it there. So we talked about Part A being really inexpensive, and that's the liability side. I think the mistake people make on Part A is, cutting back to 50,000 instead of 100. If they just compare it, it's not that much higher of a premium, because the frequency is, it is one of the most dangerous things we do, but the frequency is not that high. Part B and C, a lot of that's medical and those type of expenses that you have other coverage for. So you can kind of question that. I don't know if y'all going out and price the difference between those two. Part D is comp and collision. So it's collision or all other comprehensive coverages. Collision is, your car hitting something else. another vehicle, another object. Other than collision, comprehensive is essentially all risk for any other kind of damage. It's got a lower deductible than collision, but it's essentially any damage to your car. I was watching in Australia, a lady had a Porsche SUV, which sounds kind of strange to me, but an expensive car in her garage, locked up. And this guy broke into her garage. And Australia, she had the key for the car was locked in the garage. And if you have your key next to the car, you don't get coverage. So she had no coverage. They found the car, but had to be repaired. But so you know, so there are. I don't think there's anything like that at all in the United States. I've never heard. I mean, I guess if you left the key in the car intentionally with the windows down, there might. I don't know. I'd have to read the policy to see. That might be considered almost intentional. For non-owned vehicles, I'm not going to get into detail here, but the real key here for rental cars is if you're not sure, call your insurance before you leave. You can save yourself a lot of headaches by knowing in advance. If you've never rented a car in the US, your best bet might be the credit card, but don't assume your credit card provides that coverage. Read the back of the card, check on it. So don't assume, but especially if you go overseas or go outside of the US, call your insurance company and ask what are the rules. What is not covered? You know, this is not wear and tear. I know there are like these auto maintenance type of contracts. That's not insurance technically, so they're not insuring wear and tear in your car. You know, they look at the damage. They're going to have, you know, what if mechanical problems or wear and tear is what caused the accident? Those kind of things. There can be some debates. The loss payee. There are times where you may not be covered, but your lender might be covered. So there's times where you may get nothing, but they may at least get their money back. And then equipment in the car is not covered unless it's permanently part of the car. Your homeowners is going to cover, you know, so if you have, like me, when I got my bike stolen out of my car, that was covered by my homeowners. In fact, I got nothing out of the auto because they broke the window and that wasn't enough to hit my deductible, but my homeowners essentially paid almost the entire price for my bike. It gives you actual cash value. And here, if you've never used Kelly Blue Book, it is a pretty cool site. Price, my car's value. Oh, I don't have my VIN, but you can put your car in there. Let's see if it will let me do make and models. So I think I have a 2017 Toyota Prius. I don't know, Prius Prime. Mileage. Oh my word, what is it? Boy, it's not much. 55,000. I don't travel that much. 7, 8. Let's see if it will tell me. Oh, hatchback. What's advanced hatchback? What equipment? Now, why does the color matter? That would be, oh, it's red. Why would that matter? But it's in excellent condition if you don't count the scratches of me. So see, they're not going to tell me. They used to actually tell you on their site, but
It
yeah.
says not now, maybe later.
Huh?
It says not now, maybe later. Maybe you can.
Oh, is that what it's? Oh, there you go. Good job. All right. Is it there though?
Yeah.
18 to 20. That's essentially what I paid for it 4 years ago. So,
Oh, wow.
yeah, it hasn't lost much value. It actually could have sold it for like a 20% gain back when used car prices went up. And I ride my bike so much, I'm tempted to just get rid of the car and just go totally cycle. But so this should be pretty close to your actual cash value of the car. It can give you a good indication, at least give you some idea of what they might offer you. They don't have to give you the actual cash value. They can repair or replace. And there is a coordination of benefits, so, you know, if you have the car rental insurance or whatever. Y'all may not realize this. It used to be when you rented a car, they push the rental insurance really hard. They don't do that anymore. I think most people have figured out that it's duplicate coverage. You don't really need it. I never buy the rental because you're pretty well you're covered by your auto insurance. Everything covers you is the same. And that rental insurance is ridiculously expensive. I remember once I had my car being repaired and they say, we'll give you a free rental car. So that's great. Free rental car. So we get the free rental car and they're going to charge me like $30 a day for the insurance. I mean, you think about it, $30 a day, 30 times 365 days, that's like $10,950 for insurance. Would you pay $10,950 for auto insurance? Makes no sense. And that's just covering physical because your liability is covered, you know, obviously you're covered. And he said, and he goes, well, it's only $30. Yeah, $30 a day. Does that sound like a free car? So I turned him down. He was mad. Why was he mad? Because that's how they make their money. That used to be what rental cars were. They made their money off the insurance. But they've stopped pushing it just because I think we've learned that. You do have some duties. You do have to notify the insurer, some proof of loss. Insurance companies have gotten really good. Fortunately, I've never had to do this, but generally today you have a mobile app, and I don't know if any of y'all have done that, where you take a picture at the site and you submit it immediately. It's pretty cool. Any investigation, and then you have to protect the property from any other loss. You can call the police to the accident. I had one person do that to me. I thought it was ridiculous because there was no damage and we had to sit there forever waiting for the police to show up. So kind of a waste of time. And the police, you know, what are they going to do? But the insurance company has the right to subrogation. We'll look at subrogation later when we look at Schedule P, and you'll see how much subrogation is. That's their right. Essentially, once they pay you for the car, it's their car. And so, and you can't jeopardize that right. You know, don't ever. One guy hit us once, and he's like, "Hey, I'll just give you $50." And the guy who was driving was smart. He says, "No, I'm not going to do that. Give me your insurance." And the guy didn't want to give him the insurance because it's going to affect his rate. But it's like, I may never see you again. There may be more damage than I see. You know, you can't do that. Once you have that kind of deal with somebody else, your insurance company can say you're no longer covered. You weren't supposed to negotiate with that person, so you essentially canceled your insurance when you did that. And yeah, again, when you travel, you may be okay if you go to Puerto Rico. I did see a video of a guy from Puerto Rico in the United States renting a car, and they wouldn't let him rent it because he didn't have a passport. And what kind of passport do you need if you live in Puerto Rico? You don't need one.
Yeah.
They're a U.S., you know, they're part of the United States, and they're like, you have to have a passport. No, you don't. So they should be able to rent cars, and you should be able to rent a car in Puerto Rico just like you're in the United States. But I would still call just to make sure. There are some endorsements for rental coverage if you need that. Towing and labor. Towing and labor to me is incredibly expensive if you look at it relative to what you're getting covered, but it's really cheap in terms, you know, you're talking a few dollars a year. But when you add it up, how often and I'm not just how much are you towed, how often you towed, how often are you towed for a covered loss? Because if you're getting towed because your engine broke or something, you know, some non-covered loss, then you got to pay for that yourself. So you're talking about getting towed because of a covered loss. That may happen 2 or 3 times in your lifetime. So if you're paying $10 a year, you know, you're gonna pay a lot over your lifetime. So that's you know, remember we talked about low frequency, high severity. Towing and labor is low frequency, low severity. I would just, you know you're gonna pay more, so why get it covered? And we already talked about this. As you go to other states, you got this automatic coverage. Here were my premiums. I haven't priced this in a while. For my parts B and C, it was $122 a year, but I'm sure it's much higher now. B was 51, C was 70. So y'all might try it and just see what it is. What I did, I took that entire 122 and just put it in Part A. And I just bought more liability because it was my concern. All right. So we're gonna get into a special issue. It's a somewhat of a touchy issue, but I love it. It's one of those that's a few years old because I can't find a more recent one that's this impressive. So on Canvas, the articles are out there if you want to look at them. So I'm going to be covering, there's 3 articles, 1, 2, and 3 on credit scores. We're going to go out of order. We're going to start with number 2 first. So we're going to do the first couple pages of 2, then flip to 1, then come back to 2, and then we'll look at how Allstate got sued on credit scores. I don't even know my credit score because I never borrow money. So I don't know why it's not 700 because I don't have any debt, but I never check it because I don't need to. But you probably are aware of yours. And maybe have not thought about how it's impacting your auto insurance rates. But this happened about 20 years ago. Here's Jose Montemayor. Remember, he was in place for the mold issue as well. So I wish I could get him back for our class. He was even more animated on this issue than he was on the mold. He was pretty irate about this issue in the insurance industry's behalf. The reason I want to start with Article 2 is that he wrote a letter to the legislature because they asked him to do this study. And I don't know if any other state has done this. Texas might have been the only state that did this. But the legislation asked him to run this study on credit scores because there have been so many complaints on credit scores. So he writes this letter. I don't know if you remember Rick Perry, Dewhurst, man, those are old names, Craddock, but essentially to the Texas Congress. And so I want to start here because there's some important concepts, the definitions of what he's doing here. I'm not going to say he's not honest in this, but in my class, he said things that were somewhat different what he wrote here. So there's a place where he says, I was surprised to find, and I'm thinking, no, he wasn't surprised to find that. He knew he was going to find that the whole time, but he's trying to be a little political here. Okay, so here's a key term. There's 3 really important terms here. One of them is disproportionate impact. There's unfair discrimination, intentional discrimination, and disproportionate impact. I don't like the first 2 because I think they're switched. I would have switched the definitions of each one of those, but so his question is, what do we do with disproportionate impact? Because of the 3, it's the only one that's not illegal. So we'll have to define those. But he's saying there's no definition, there's no precise threshold for determining disproportionate impact. I express disproportionate impact in terms of a relationship over or underrepresented. So disproportionate impact is you're not underwriting on this, but you're underwriting on A, but when you underwrite on A, it has an impact on B. So when you underwrite on A, it might impact young people more than old people. You're not intentionally discriminating between old and young people, but B has some relationship to it. The key, I think, that we're going to try to keep in mind here is false positives, false negatives. Now, I have to think about which one's which here, but I'll just guess. You actuaries can tell me. So false positive, it's probably how I expressed it. So someone with a low credit score actually drives very well. Is that a false positive or a false negative? I mean, you could probably switch it either way, right? Someone, what is this one then? Someone with a high credit score does what? Drives poorly. All right, so you can switch it either way, but a false positive is, hey, they got a low credit score, we're identifying it as a bad driver, and they're actually not. False negative is, hey, we're saying they have a, yeah, I'm not sure. If anyone has an idea which it should be. It probably depends on how I express the null hypothesis. Right, so here's the key. Are there people with bad credit scores that drive very well? Obviously, yes. Are there people with great credit scores that drive poorly? Obviously. All right, so that's what this is looking at, but they're looking even further. Is there a relation between credit scores and things that are illegal to underwrite on that are perfectly predictable? And you can see his conclusion on this. And then the other thing I'm going to focus on is there an alternative to this. We'll talk about the alternatives with telematics. So disproportionate impact is where I see that false positive and false negative kind of coming into play and where it's unfair. So he's talking about some overrepresentation of certain groups, and then it's unfair if there's people with low credit scores that are good drivers because they're being discriminated on this, and it's also hitting one of these protected classes. So they have two phases of the study. We're going to talk about that. So let's do a high level here. So phase 1, phase 2, so we can know high level. Phase 1 was a univariate analysis. Phase 2, you want to guess? Multivariate. Oh, wow. I don't know how to spell multivariate. Let's see, well, typos. Yes, I did know how to spell it. So the first phase, all they're going to ask is there a relationship between credit scores and driving? All right. The second one is when you use credit scores in conjunction with all other factors, does it add any further analysis? Does it tell you more that you can't just get from those factors? All right. So the reason I'm showing you the second study is so we can set all this up because he does a good job of discussing it. So the second phase of the study is, and this is a great quote, if and to what extent credit scores enables an insurer to more accurately predict losses in conjunctions, even when you have all these other factors. So who has worse credit scores, young drivers or old drivers?
Younger.
Young drivers. Who tends to drive worse, young drivers or old drivers? Not really old, but young drivers is what insurers are going to tell you. Well, that seems unfair. They're young to have low credit scores, and they're young, so they're getting charged more as bad drivers. What if we just look at their youth, look at their age? Would that tell you everything you need out of credit scores? And what did they find out? This is an important phrase right here. The second phase indicates that credit score significantly improves pricing accuracy, even when, he should have said even when combined with other variables. It's an additional piece of information. And he's the one that picked the word significantly. I didn't give him that word. And what are the actuaries saying? Well, duh, we already knew that. You're testing stuff we already test automatically, so you're not telling us anything we don't know. I asked the UTSA actuaries about this. He said, yeah, everybody knows that. Every actuary knows this. There's no debate. They were like, yeah, do your study. You're going to find the same thing we already know. It's like, it was a very, very strong relationship. All right. So let's distinguish when something's legal and not legal. So insurance can discriminate very uniquely as well, because if you think about it, we know they discriminate on age for life insurance and auto insurance. Who else can discriminate on age? So anybody gives a senior discount, they can give old people a discount, but and HEB say, hey, you're 72, we charge you 20% more. We just old people, they're not good customers here. You make the place look, like we want young, vibrant people here. And you can't do that. Be illegal, right? Age discrimination is illegal in most places. What about gender? Men are charged more for insurance than women. What other field can you do that? Maybe what is it, ladies' night at the bar or something, whatever. Who knows what it is, but insurance can discriminate on stuff you can't discriminate on anywhere else, but they can't discriminate everywhere. And so these you can see if you think these are backwards to me. So unfair discrimination and intentional discrimination. Unfair discrimination is the unequal treatment of individuals in the same class. What they're saying here is there's two people whose frequency and severity exactly the same, but you charge them more than them just because you don't like this group. You can't do that. You have to have a better way to say this. So on unfair discrimination, let me copy this in so we can not what I. You must have actuarial support for all rate differences. You have to prove, and again, we're talking about what? Frequency and severity. They don't both have to be different, but at least one of those has to be statistically different for you to charge one group more than another group. That's unfair discrimination. So if USAA says, the head actuary, hey, my son was beat up by this redhead at school. Let's charge redheads 10% more than everybody else. I just don't like those people. That would be illegal. They couldn't do that. Now, what if redheads are really bad drivers? Maybe they could probably get away with them, but they'd have to have the statistics.
Isn't that what's going on right now with the Kia vehicles?
Oh, I haven't heard that.
They call them the Kia boys. So I guess the Kia vehicles are so easily, you can steal them.
Oh,
and
so these are so.
Yeah, so they're charging, if you have a Kia, they're charging you higher insurance rates.
Well, that would be fine because it's
Right, so that's what I'm saying. That's an example of that.
well, that would be one where they do have actual support.
Oh, right.
So I'm
okay.
saying it's illegal if they don't have the actual support.
Okay, that's what I meant. So that's a fair.
That would be fair. Yeah, if they have the data to show that. Yeah, I do remember seeing that. Yeah, that was kind of crazy. All right. I would not call this unfair discrimination. I would call it intentional discrimination. Because you're just discriminating against someone for no reason. So I think there's flip, but you may disagree with me. So what is intentional discrimination? And this is the tricky one, especially this is the more important one here. This is rating different protected classes differently. You can't do that. If it's a protected class, you can't do that. Now, gender is not protected class. You can charge men more than women on auto insurance. You can charge women more than men for annuities and for health insurance. So gender is not a protected class, but there are protected classes in insurance. And let's look at them. You can probably guess what they are. Age isn't one of them. No, you can discriminate on age. So race, color, religion, national origin. Those are ones you cannot discriminate on. Now, this is a very, very tough issue, which is one reason I want to cover it. It's a touchy issue, but this is a big issue for the auto insurance side, especially and for homeowners. Have y'all heard the term redlining before? So redlining, you don't provide insurance in certain neighborhoods just because you don't like those neighborhoods. Insurance does stuff that looks a lot like redlining, and they've had some really tough kind of public relations issues with this. So this is a touchy issue for the insurance industry. But then the last one is disproportionate. Oh, make sure I got this spelled right. Disproportionate. I think I spelled it right. This one's legal. The other two are not legal. What that means is there may be a protected class that because you use credit scores, on average, they're harmed more than another class. But that's legal. You can do that. So let's take age as an example. You discriminate based on age. Let's say there's more young African Americans than young Caucasians. So you're going to discriminate more against them than the other group. But there's just more of them. So you say, well, is that discriminatory? Well, your age is what you're doing. It just happens that this disproportionately hit that group more than this group just because there's a difference in the makeup of those groups. All right, so what he was charged with wasn't to figure out if insurance had a disproportionate impact, because he's going to argue there's nothing he can do about it because that's not illegal. What he had to figure out was, did credit score somehow fall in one of these two categories? And so phase one answered this first question. Is there a statistical relationship between credit scores and frequency and severity? The answer is yes, absolutely. So there is actual support for using it. The second phase was asking this one. Since we know there's a disproportionate impact and you have other factors you can use, is credits, and he's got a quote in here. Oh, I got to find it. You know, remember how Warren Buffett had that great quote? He has, I don't know how to spell it. How do you spell sinister? S-I-N? Sinis. There it is. He and Warren Buffett must write together here. It's a great comment. What phase two is asking is credit scores being used as a surrogate for something sinister. Isn't that great? A surrogate for something sinister. Since what they're saying is, hey, we want to discriminate based on race, but we can't do that. But we can use credit scores and we'll get the same thing by doing that. That's what he's asking. So is credit scores a surrogate for something sinister? And by sinister, he means illegal. And he's really on that one talking about intentional discrimination, which I think to me is unfair discrimination. But y'all see what y'all agree with me? They're kind of switched or not? I'm not going to ask you on an exam which is which, because I don't think it's important. To me, they're backwards. I remember them because I just remember it's backwards of what I think. So that's how I remember which one's which. But right. So the first part of the study say, hey, is there statistical support? Yes, there is. Well, is there statistical support? Is it just a surrogate for something that's not allowed? So that's where they're going in this study. So disproportionate impact, it gives more definition here. A lack of symmetry or unequal percentages. In other words, disproportionate is an uneven distribution of each racial group within a given risk factor, although the uneven distribution is not caused. So this is pretty important here. So let's say, let me use green and blue people. Let's say green have lower credit scores. Blue have higher credit scores. If credit scores could perfectly predict what someone's race is, they would be illegal. If 100% of people with low credit scores are green and 100% of people with high credit scores are blue, you'd have a problem. But it's okay if what?
You have a mix.
If there are some people, some green people with good credit scores, if that's the case, then it doesn't fall into the illegal category, right? I don't know if did I type it all right. All right, so if it's 100% it doesn't work, they'll probably the state would make it illegal. But so that's what they're asking: is credit score is a perfect predictor of this one thing? And so the study has a lot of tables that we won't look at, and the appendix goes on forever. So don't print these articles out on your printer. You'll be really disappointed. There's a lot of tables that are completely unnecessary. So, and there's blue people with bad credit scores, as long as, and it's pretty significant. You cannot predict someone's race based on their credit scores. It's not that predictable. There's a skewing, there's a statistical difference, but it's not so massive that it's predictable. By the nature, and he's going to say disproportionate impact. If you don't like it, then you need to shut insurance down, because it's going to happen. Anytime you have anything that discriminates, it's going to unequally hit one group versus another. Always, it's just unavoidable. So by the nature of this risk-based pricing and underwriting, all factors used in insurance have disproportionate impact to some extent. One could make a convincing argument to ban the use of risk-related factors. There are some people who want to do that. So there's a group that wants you to buy your auto insurance at the gas pump. And their argument is the only thing that matters is how many miles you drive. Does that seem fair? It's called pay at the pump. I don't think it has any hope of ever passing. And then it kind of has been destroyed because of electric vehicles. I mean, I would love it. I don't buy gas, but maybe once every 2 years. So that would like save me a lot of money. But yeah, that's that argument. That eliminates all of this, except for then you discriminate against who? People who drive a lot. Is it possible people who drive a lot are more of one race than another race, and you still have a disproportionate impact? So, you can't, there's no perfect way. But he said, can we eliminate everything? Now, you could say eliminate everything and everybody gets charged the exact same rate. We're going to talk about what happens when you do that, because that's the whole market collapses when you do that. We would ban risk-based pricing, underwriting, revert to pricing system where harmonized risk and essentially charge everyone the same price. That would be a set. Now, he does have some political statements in here. That would be a setback to all Texans of all races, especially those of moderate to low income whose risk remains low. All right, so this is the other thing they're going to bring up, is this idea of availability. The insurance industry is going to argue the fact that you use credit scores is going to help these green people with good scores get good insurance. We're helping them. This is in their best interest. And that's kind of their availability argument. Yeah, it's going to hurt these people, but it's going to help these people, and these people need insurance. Important comment right here. Jose Montemayor, he has the authority that in unfair discrimination, intentional discrimination, he does not have a legal basis to ban the practice that's disproportionate impact if it produces an actuarially supported result and is not unfairly or intentionally discriminatory. Now, this is the sentence, and he's not here to defend himself. I don't think this is true, but based on what he said in my class. Prior to the study, my initial suspicions were that while there may be a correlation to risk, credit scores, value, and pricing and underwriting was superficial, that you could get it out of the other factors. He didn't say that in my class. He was like, yeah, it was obvious credit scores give you new information. So maybe someone else wrote that sentence. Maybe he wrote that to make it, hey, I mean, it sounds good, right? You do a study and say, hey, we went in thinking this, when we found this. It makes it sound more authoritative and unbiased. Hence, there would be an evidence that credit score was a coincidental variable that served as a surrogate for unlawful rating and underwriting. If this were proven, I would have had a legal basis to link it to intentional discrimination and either ban or adopt an allowable rate difference of 0, meaning no rate differences. The study, however, did not support these suspicions. Credit scoring, if continued, is not unfairly discriminatory and is not based on race or precise indicator of race. So he's essentially saying, hey, it's out of my hands. Now, he does end up telling the, did I highlight that? Telling the legislatures, hey, if you want to make disproportionate impact, you want to just make credit scores illegal, you can do that. You can add that to the protected class. So he, again, he's kind of a good politician here. If the presence of credit scoring and insurance will only feed suspicion and divide us as Texans, its continued use to any degree may simply not be worth it. If the legislator determines that credit scores should be eliminated, then I would recommend it be phased out over time. He doesn't want it to happen overnight. Otherwise, people with good credit scores are going to see a 40% increase in their rates overnight, and they're probably going to be upset about that. So this is a really well-written letter. If you go through it, I highlighted the pieces to it. So you see what we're up against with credit scores. So we have to get the data here. There's a lot of actuarial information here. There's some actuarial phrases in here that don't make sense to me. I don't have any actuarial students that have been able to explain it to me either. One phrase that I think is interesting to me is statistical analysis versus actuarial analysis. I don't see a difference because that's what actuaries are doing, is statistical analysis. So I think what they mean by actuarial analysis is using data that's very specific to the insurance industry, like pure premiums and those kind of things, but it's still statistical. I don't know why you would say it's no longer statistical because we're using industry-specific data because you use industry-specific data for statistical analysis all the time. So there's a few phrases here I think are a little strange. But this first one really sets it up well. The other thing he asked in phase one, he also asked, is it disproportionately, or does it have a disproportionate, boy, that's not even close, disproportionate impact. So that asks that question. So two questions in phase one. Is there a relationship between credits, scores, and losses, frequency and severity? And does the use of credit scores have a disproportionate impact? What do you think the answer to the first question is? Yes, and strong. And what's the answer to the second question? Yes. Now, it has a big impact on age, and I think a lot of young drivers is like, this really feels like piling on, doubling up, because we're already getting charged more. So there's been some arguments there, but that relationship age is already legal. And so throwing out on top of that is just, you know, it's just means young people pay a whole lot more for insurance. So the second one was, do credit scores provide additional statistical insight over all other factors? What was the answer there? Yes, significant. Oh, I don't know if Miss Quinius is still living, my high school typing teacher, but she's not. She's looking down from heaven and very upset. And I learned typing on an electric typewriter, which is all right. So that's the entire study. So what we got to do is we know the answers. Now we just need to look at the data and see what's going on. WOAI, it was probably Joe Pags had one of his shows. I don't know if he's still on or not, but one of his shows was on credit scores and auto insurance. And he invited a guy from Allstate, and that poor guy from Allstate was just beat up left to right. Every call for upset people. Well, who was calling in?
People
with bad credit scores. People with good credit scores weren't calling in because they probably didn't care. I don't know why I keep hitting that. All right, so we're going to jump back to the other article and look at some of the data so we can set this up. So go back to the first article. So just give you some background on this, how they got the data. This is for both, they did this for homeowners and auto insurance. It's a much bigger issue for auto. It's not that big of an issue for homeowners, but it is impact homeowners. One thing you'll notice when we read this is the study had a problem with homeowners because there was some noise in the data. I don't know if any of y'all can guess what that noise was, but something unusual was going on when they did this study. Any guesses? What would I expect you to be aware of that we've talked about? So this was right in the middle of the mold crisis, and the mold crisis were messing their numbers up. And so the homeowners, they came out of the study a little bit uncertain on homeowners. So they went to the 6 leading insurance groups. I don't know if USA is in there, but probably USA is generally the 5th or 6th largest. 1.2 million auto, 800,000 for homeowners. But obviously the insurance industry is more than happy to share this data. They knew what they were going to find because they found it themselves. They used data to analyze whether use of, well, here's the 2 questions. whether the use of credit scores impacts certain class of individuals more than others, and does it predict claim experience? Now, when you see claims experience, hopefully I've gotten you thinking this way. The first two words that come to mind are frequency, severity. All right. Is this more an impact on frequency, or is it more related to severity? Which does it predict more? And then you have auto and you have home. Now, you may think it's obvious, but sorry, I'm using this as a scratch page. Severity. So you have someone with a strong credit score. What kind of car did they own? A cheap car or an expensive car?
Very cheap.
Oh, you think so? I was thinking wealthy. So I don't know.
Oh, strong, I'm sorry, yes.
Someone with a strong probably has. So what does that do? So the frequency may be lower, but the severity is going to be higher because the car costs a lot more. So you can see there's some mixed factors here. Same thing with homeowners. Someone with a good credit score probably owns a more expensive house. So the frequency may be lower, but the severity be higher. So you can see it's not an obvious thing here. I will tell you the relationship is generally on auto is more related to the frequency. On homeowners, there's some uncertainty there because of the mold issue. The policyholder data shows consistent pattern of differences in credit scores among different groups. There appears to be a strong relationship between credit scores and claims experience on an aggregate basis. It is necessary to evaluate if and to what extent credit scores enable insurers to more accurately predict loss. This is phase 2 that he's setting up. So he's saying the answer to the first question is absolutely, there is a strong relationship. The department is in the process, so this is the first study, of conducting a multivariate, did I spell that right? Multivariate analysis? Multivariate analysis, yeah. The individual policy of that data does not include information on income. So how do they say, hey, is this impacting people with different income differently? Well, they use zip code. They just assume people in certain zip codes had certain incomes. So they had to make some assumptions. They used census data and zip code. The difference in average credit scores between income levels are not as large as they are for racial ethnic groups. The data shows the average credit scores for income are better. It's amazing to me. There are some wealthy people with horrible credit scores. I don't understand that. I don't know how someone making 7 digits has a bad credit score. I was watching Undercover Boss, and it was the guy from Choice Hotels, and they showed his house, and man, it was this mansion. And I looked up his income. He wasn't getting paid a whole lot more than I was at USAA. I was like, I wouldn't live in a house like that. So he was living way above his means. But he was a CEO of a major organization, so he's like, I should be living in a 10,000 square foot house. So he probably had a bad credit score because there's no way he could afford the house and what he was getting paid. So yeah, there are people with bad credit scores. There are people with great credit scores that don't make much money. There's wealthy people with bad credit scores. The moderate income level populations tend to be overrepresented. Obviously, there's a lot more people in the middle than on the ends. So there are some data issues here. It shows a consistent pattern difference in credit scores depending on age. Obviously, young people have worse credit scores than older people. And I think if he did have a suspicion, was that age was probably going to be the one factor that was probably going to be work better than credit scores, and that you could eliminate credit scores and just stick with age. The problem with that assumption, which I think he knew, is that P&C actuaries would have figured that out already. They wouldn't be asking for credit scores if they didn't already know that. So there's not. Maybe there's people out there who think actuaries are really sinister people and say, credit scores don't really matter, but boy, let's use them because I really want to hurt these poor people. I don't think there's actuaries like that. The number of credit related. So here's part of the reason why the legislature is having to do this. There was a lot of complaints about the use of credit scores coming to the department. They actually show you a chart somewhere in here showing all the complaints. So number of complaints received on auto. Now the home is probably somewhat related to the mold issue, but the use of credit scores, you can see a huge increase and then dropping back off. Based on the review, insurers writing probably 40%, 55%. So they're getting a pretty significant part of the market. These numbers do not include those insurers whose use of credit score is mainly just, accept or reject. We're going to talk about that with Allstate. Well, Allstate in California, it's illegal to use credit scores. And Allstate got sued, and they say, we're not using credit scores to charge people more and less for insurance. We're using it to see if they're going to pay their bill. So we're doing it for like a collection agency. It's like, hey, you got this premium you pay over 9 months, but you're not paying your bills, so we can't. So you can have this insurance, but you got to pay us all up front. Well, if you tell someone with a low credit score that they have to pay their entire bill today, what are they probably going to do? So it's essentially an easy way to cancel someone, but say you're not doing it because of credit score. So they got in trouble with that, and they had to stop doing that. So rates varied. So this is really, really important. Rates varied as little as 11% to one instance 400%. So obviously one company was really, really using credit scores quite dramatically. So we'll get into that. We'll look at so this is the charge you got from the Department of Insurance based on this law, has to present a report to the governor, lieutenant governor, and speaker house. You saw those three regarding the use of credit information by insurers. I don't know exactly how the law was written. We want to see if it does this, if it does this, whatever, how specific that was. Credit scores are typically a model. Insurance companies use credit scores quite a bit. Essentially a mathematical formula. Which firm does this? Probably the one you're most familiar with. Insurance companies use this form a lot. Equifax. Have y'all heard of Equifax? So I have a former student working at Equifax. I haven't seen him in a while. He just got married. I need to go back and visit him again. He's up in Kansas. I visited him a few years ago. I haven't seen him since. Equifax had never hired someone right out of college. They didn't do that. And they decided to try it. And somehow they got UTSA and they hired this guy and they love him. They were like fighting over him. So I was like, good job. But they haven't been back since. So I don't know what the issue. But Equifax is a data firm. They provide credit and then a lot of other information, not just credit information. At USAA, we use them for some blood tests and other kind of things from the life insurance side. So this is just a firm that, an actuary could work for this firm. It's just a big statistical firm. And credit scores is a big part of what they do. I don't know if they do the score that you get when you get those things in the email. So there's these formulas. Obviously, banks use them a lot to try to figure out whom they can loan money to. Can be things like number of credit cards, how many times you've been late. It's a single numerical value. I forget what it ranges from, but numerical value, I think 700 may be the highest or something like that. But it's a numerical value, which is great for actuaries because it's quantitative. It's a pretty easy thing to use. Unlike credit ratings. Credit ratings are letters, AAA, AA, single A. You can't do much with that data. You'd have to convert the letters and the numbers. But here's a number. It comes out as a number, and it's ordinal. So 700 versus 600 versus 500. It's a relationship that makes sense as you move up and down the scale. It's not like 700 slightly better than 600, but 600 is a whole lot better than 500. It's a fairly well distributed analysis. So here's another important chart. This is on personal auto. There's some people who are seeing as much as a 40% discount because of the credit scores. There's some people seeing as high as a 60% increase because of credit score. I will get this into your answer. I think this is pretty critical because it shows you how impactful it is. There's a lot right in the middle, but if you add up these bars over here, you're talking fairly significant people that are getting significant increases. Now, there's a lot of people between plus or minus 20%. That's over half of it, but there's a large number of people. I mean, that's 5, 10, 20, about 20% are getting a huge discount. And 5, that's about 10% are getting a huge increase. So The chart 2 shows insurers started using expanded use of credit. The vast majority, 90%, experienced rate swings between 40 and 40%. But 40% is a big change. Almost 10% of policyholders experience more than 40% increase. This is the 10% down here. For homeowners, the impact was not as dramatic. 90% saw an increase of 30%. They have the homeowners in here. Here's the homeowners. Much tighter distribution. Not huge discounts on the other end. And again, this can be the impact of severity. If people with good credit scores have more expensive houses, then you got to charge them more. And so insurance companies argue, so here's this term availability. Remember, adequate, not excessive, affordable, those type of things. Insurance companies love the word available. From an availability perspective, insurance companies argue that the use of credit scores improves their ability to measure risk and therefore allows them to expand spectrums that they write business. So essentially what they're saying, hey, if you didn't let us use credit scores, we'll just be charging all young drivers as, a whole lot more. But using credit scores, there's some young drivers with good credit scores. We're going to be able to give them a much better deal. We can make insurance more available to them. It kind of ignores the fact that there's some young drivers with bad credit scores, right? They're kind of like saying, well, who cares about them? They're horrible drivers. You don't want them on the street anyway. So they tend not to care about that group. This benefits consumers because insurance may become more available and may be particularly beneficial to more marginal applicants who might otherwise be declined. On the other hand, the increased rates for policyholders with below credit may have insurance unaffordable. And essentially, and the insurance industry never says this, if it's so unaffordable, it essentially becomes unavailable. I don't know why the insurance industry never says that out loud. This outcome could occur with the use of other variables as well, not just credit score, obviously. Some consumers may question the relevance. So this is the big argument, right? So let's talk about this. Actuaries, y'all talk about this all the time, don't you? Have y'all heard that argument? Correlation versus causation. So do bad credit scores cause us to drive poorly? Does that make any sense? And that's the question people are asking WOI. What does my credit score have to do with my driving? So is there causation? Anybody think it's causation? Or is it correlation?
Correlation.
So if it's correlation, this implies what? A third factor that causes both bad credit scores and bad driving. What could that factor be? What is that factor of people that both causes them to have bad credit scores and causes them to be bad drivers?
Not being responsible.
Yeah, irresponsibility. And boy, I can't even, I'm too irresponsible to spell irresponsibility. And Bill Gates can't help me there. Boy, it's not, that's not, I'm not even in the ballpark there. So why don't they just grade on that? How would you find out someone's irresponsibility? Well, maybe look at their credit score. Maybe, right? Now, younger people are going to say, well, but there's a lot more to credit score than just irresponsible. I'm young. I don't have a lot of credit history. Yeah, so there's other things going on. But do actuaries care if it's correlation or causation? And to them, they don't care. In fact, it's possible, you might think this is crazy. It's possible for actuaries, they're taking the causal factor to predict, and they may be going backwards. So A causes B, but they're using B to predict A. Because all they care is that the data is there and it predicts. So they almost don't even care about causation. They just need a price. So, all right. So here, irresponsible. I'm guessing that's what it is. I can't say that for sure, but you would think people with bad credit scores aren't paying their bills well. Does that mean they're also bad drivers? I don't know. You know, can y'all think of any other factor? We know, and I hate to insult y'all, and I'm not trying to, we know there's definitely a relationship on age. No question. Young people are, especially young men, are more aggressive drivers. And they have worse credit scores, partly just because they're young. I mean, that's just the nature of credit scores. So could age be the other factor? So we're going to test that in phase 2. And in phase 2, they're going to say there is a relationship to age, but it is not the determining factor. There's something about credit scores that tells us something that age doesn't tell us. All right. So actuaries don't care. I don't even know if actuaries even talk about causation. They're just looking at the data. If we use this data, we'll have better pricing. Now, should regulators care? Why do regulators care? This is why regulators care. Right? It's much easier to price causation than it is the price correlation. So how many complaints do they get that young people pay more for insurance than older people? Most people just accept that. Do they get complaints that people with more speeding tickets pay more for insurance? People with fewer, they don't. And people accept that. They kind of acknowledge that those make sense. It's credit scores that causes the problem because people are looking for the causation and actuaries are looking for the correlation. So it's an important concept. So some consumers question the relevance. In contrast, relationship from more traditional age, driving record is accepted and people don't question that as much. All right, we'll jump through some of this. Here's the numbers that they had. They did have a lot of unknown. They're using some census data and some other things, but a lot of their data they're pulling from the insurance company. And you know, insurance companies are not going to collect data on race. That's the last thing they want in their database. So, you know, how they're getting this information is itself a little bit of a challenge. All right, so now you can get these tables that I hate. I find these tables incredibly difficult to read. So if you want to read through them, you can. We're just going to read the words because it's a lot easier. But you can look at the things they looked at. They looked at income. So this might be something getting into your notes. They looked at the disproportionate impact on race. Or not just this, I mean, in a sense of what they're asking, is there a relationship between credit scores and race? Is there a relationship between credit scores and income? And then age is probably the last one, and age. So those are the 3 things they looked at. I don't think they looked at gender because gender is pretty tough because you have a household, you know, if you have a family, 2 spouses, whatever, it could be a little tougher. So race, age, and income. And income was the one they really struggled with getting that data, although I'm not really sure how they got race in here. But I find these tables really tough. I would not have done a stacked bar to see this data. Because to me, it's really hard. I can't tell. You know, the problem with the stack bar, you're trying to say, is this bigger than this or what? You know, it's kind of hard to tell. Is this way up here because it's larger or because this is larger? And so it's just, I don't like how you actuaries can probably do it without any problem, but I'm not trained to think that way. All right, so let's get some definitions. Pure premium versus loss ratios. Okay, so pure premium is defined, and we're going to use pure premium in a few places. So pure premium is for the auto insurance side, the loss ratio they use for the homeowners. I don't think exactly explain why, because you can do pure premium for homeowners, you can do loss ratio for autos, so you don't have to do this, but they decided to do it like this, probably because of the value of the home versus the value of the car. So pure premium is, well, those that took my life insurance class, we were doing pure premium last semester, but we didn't call it pure premium. We called it, anybody remember? You probably don't. We called it the net premium. So what was the premium you did last semester? You calculated a premium that all it did was cover the loss. There was no expenses, no profit. How much do you need to charge so you exactly cover the loss and nothing else? That's a pure premium. So a pure premium $2 means that on average, insurance claims are going to be $200 per vehicle year. Are you going to pay $200 for insurance? No, they're going to add expenses and profits. So you may be paying $240. But if you pay 200, you'd expect to get $200 back exactly. The loss ratio we already talked about, because we did the combined ratio when you did paper one, the combined ratio, you had the loss ratio, the LAE ratio, and expense ratio. So the loss ratio is your losses divided by your premium. So loss ratio is the dollar amount of losses divided by the dollar. And they say earned premium. We'll talk about earned premium versus written premium. In reality, the loss ratios are to written premium. Why they did it to earned premium, I don't know, but that's the loss ratio they're doing. So 70% means if you get $100 in premium, you're going to pay out $70 in losses. All right. They may explain in here why pure premium works better for auto, but you know, that's not important to our needs. But it is good to know these definitions. So insurance risk was measured either by pure premium or loss ratios. So this chart is one I would put in your answer. So this is an exam question, but it's open book, so you can copy and paste these in here. So does it look like there's a relationship here? So down here is credit scores. These are high credit scores. These are weak. They didn't do it on the credit score scale. They did a scale of 1 to 10. And this is the pure premium. All right. So over here is going to be dollars. When we look at homeowners, it's going to be percents because it's a ratio. But on auto insurance, it's a dollar amount. And so what they're saying, someone with a bad credit score, they should be charged $360. Someone with a really good credit score, they should be charged about $170. Pretty big difference. Does that look like a relationship? Statistically significant relationship. Now, I don't know why they say group F. There's a lot in here we don't need to worry about. You notice this thing is 72 pages, and we're going to skip like the last 40 pages because it's just chart after chart after chart. Now, look at homeowners, and you tell me if it's as obvious. You might find it a little weaker here. So homeowners, not as strong relations here, and then something's going on over here. This is the part they're saying they've got some problem with mold going on. There's something crazy going on with the numbers, but it's not as strong a relationship here, and it's just on the edges. So again, 300% versus 100%, and you can see 100, 150%. So it's like generally like a 50% difference. Like up here is much greater. You're talking 160 versus over 200. So much bigger difference on the auto, except for those first 3 points. All right. So there is a relationship on the exam. I would just do this chart here and just tuck it there. You could put the homeowners in there, but all right. So then the next big question is frequency versus severity. Sorry, Steve.
I just have a question because, okay, so like with you see like there's a correlation between like the car insurance claims and the actual and the credit scores. But I mean, it could just be argued that the people with higher credit scores that have like a lower loss like claim just are better with money, so they just saved their money, so they never even claimed it. They just went and fixed the car themselves.
Yeah, I don't know if they studied that. I don't on auto.
Because I know that's like really.
I think that was the mold issue. Because remember on the mold issue, people weren't filing claims because they're worried they're going to get canceled,
Okay.
and so that caused a distortion. Auto.
Because I know that's what realistically that's what I did when I messed up my car. I didn't file a claim. I just fixed it on my own because I didn't want it to hit my
Yeah. I would. Yeah. I don't know. I don't think they study that at all in here, and actuaries know about that, so they would be part of their pricing. So it's possible. If it's material enough that it would have skewed this in some way, I don't know. We'd have to see. I do think they were worried about that on homeowners because there was definitely some noise going on then. I mean, I've had actuaries question some of the analysis they do in here. It's like, wow, my stats class, we would have never done it like that. I haven't had stats in several years, so some of these, you know, what is it, chi-squared, whatever. Some of these things, you know, we don't use in finance, so they're hard for me to remember. Although that one's one of the easier ones, but I had to always look it up. All right, so the other issue, and you do want to put this into your answer, is frequency versus severity. That's going to be important. The data shows credit scores has a stronger relationship to frequency than severity. As credit scores improve, frequency decreases. Severity may decrease as well, but not at the same rate. For some data sets, severity is nearly flat. So this is definitely a frequency thing. Here's where, I mean, kind of, Steve, to your point, this is where I think the relationship between credit scores and the value of the car may come in, because you would think there'd be an opposite relationship there. People with good credit scores have more expensive cars, so the frequency, the severity is going to be higher. They don't really address that in here, but that could be possible. So here's the frequency, and you know, here, do y'all see a relationship there? They said there was, but I don't really see it. It looks pretty flat to me. The issue is not whether credit scores are related to claims experience, but rather whether credit score provides additional information over and above traditional existing rating, which can enable an insurer to more accurately predict losses. The second study is going to talk a little bit more about frequency and severity on homeowner sides, so we may get into that. So definitely in your answer, you know, it's not like almost everything you do, I want you to have frequency and severity in there somewhere, because that's really dominant in what we do here. All right, so if you look at the rest of this, it's just chart after chart after chart, and it's these same charts I hate over and over again. So don't print this thing out and it's in color. That'll mess up your color printer. So you don't need any of that. You need to look at any of that, because what it is it's group D, group E, group F. You know, it's just stuff that you don't really care about. So, and it goes on forever and ever and ever and ever. So no need to look at all of that. So what we'll do next class is we're going to really get in. There's some really, really good stuff. In fact, I think the actuaries will find it interesting, because there's some stuff in here where they're talking about what kind of statistics they use. Why do they use this type versus, you know, Brownian versus whatever statistic? Why didn't they use the R squared? Those kind of things. So it's kind of interesting. So we'll start here next class. All right, let's stop it there.